Today, we are looking at just a massive stack of incredibly dense financial reports.
Okay, heavy reading today.
Very heavy. We've got regulator statements, market analysis documents, all dated March 19, 2026.
Right.
And this is basically the moment the Federal Reserve, the FDIC, and the OCC, that's the Office of the Comptroller of the Currency,
Right.
unveiled this set of heavily relaxed capital rules for the U.S. banking sector.
It was a massive pivot.
A complete paradigm shift, yeah. So our mission for this deep dive is to decode this announcement because it just fundamentally alters how much capital the nation's biggest banks are, legally required to hold in reserve.
Which is the core of how our entire financial system stays afloat.
Exactly. So to set the stage for you, the listener, I want you to imagine you have this massive rainy day savings account.
Okay.
And this isn't just like a friendly suggestion from a financial advisor. This is a liquidity buffer strictly mandated by federal law.
Right. You cannot touch it.
Right. You are legally required to hold this massive chunk of your wealth untouched. And it's specifically engineered to ensure you survive if every single financial disaster in your life hits simultaneously.
Right. The ultimate worst case scenario.
Yeah. But then suddenly the federal government knocks on your door and they tell you, hey, our models have changed.
You don't need to save nearly as much.
Exactly. Overnight, they just unlock the vault. They legally free up billions of dollars for you to deploy immediately.
Which sounds great for you.
Right. But the question we're exploring today is that sudden financial freedom actually a victory for economic growth? Or is it a massive warning sign for systemic stability?
And that tension, that exact tension between, capital velocity and systemic safety, that is the defining financial debate of this decade.
Totally.
What we are looking at in these March 2026 documents, it represents this stark, honestly, almost dizzying reversal from a highly contested, much stricter regulatory draft that they put forward back in 2023.
The 2023 blueprint.
Yeah, the banking lobby spent years fighting that original draft.
Just fighting it tooth and nail.
Exactly. Arguing it would suffocate the American economy.
Yeah.
And now, they've secured this massive rollback.
They really did. But before we dig into the nuts and bolts of the math here, the underlying numbers, we definitely need to establish a very clear impartiality disclaimer.
Yes, very important context.
Because this specific topic, it involves politically appointed figures from different administrations, and they hold vastly different regulatory philosophies.
Completely opposite views on risk.
Right. We are going to be dissecting the viewpoints of key figures, looking at the Trump administration's influence on the process, alongside regulators like Michelle Bowman and Michael Barr.
Right.
And our goal here, just to be clear, is not to endorse one political viewpoint or one philosophy over another. We are entirely focused on unpacking the mechanics, the distinct financial arguments, and the macroeconomic implications that are laid out in the source material.
We're just following the math.
Entirely impartial to the politics. We just want to see what the numbers actually say.
And honestly, the numbers themselves provide more than enough drama.
Oh, absolutely.
So our roadmap for this analysis is straightforward, but we are going deep. First, we'll explore the exact tiered mathematics of this capital reduction.
Right.
Then we'll unpack the banking industry's highly favorable view of these changes. Specifically, we need to analyze that friction between commercial lending and stock buybacks.
Where does the money actually go?
Exactly. After that, we will contrast the sharply opposing philosophies of the regulators who fought over this modeling. And finally, we will analyze why financial critics and the credit rating agencies are currently flashing these massive systemic warning signs.
It's a lot to cover. So let's start with the blueprint itself and decode this new capital math.
Let's do it.
Because on the surface, the percentage drops in the March 2026 announcement, they sound, somewhat marginal.
Yeah, single digits.
Right. But when you apply them to the balance sheets of these global financial institutions, the real-world dollar amounts are astronomical.
Truly staggering numbers.
So looking at the core data, the absolute titans of Wall Street, so we're talking the tier with Goldman Sachs, Morgan Stanley, JP Morgan Chase, Citigroup.
The big ones.
The biggest. They see their required capital drop by 4.8%.
Right. And then moving down a tier to the largest regional banks, so institutions like PNC or Truist.
Okay.
The regulators have penciled in a 5.2% drop in their capital requirements.
So a slightly bigger drop.
Yeah. And then for the smaller banks, those sitting just under the $100 billion asset threshold, we see the largest relative reduction of all.
Which is?
Coming in at a full 7.8%.
Wow. Okay, so we see this tiered approach here, basically scaling the leniency inversely to the size of the institution.
Exactly. The smaller the bank, the bigger the percentage drop.
But to truly grasp the gravity of, say, a 4.8% reduction at JP Morgan versus a 7.8% reduction at a mid-sized regional bank, we have to isolate what capital requirements actually represent mechanically.
Right, because people get this wrong all the time.
They really do. In popular media, this is so often mischaracterized as just like a literal pile of cash sitting in a vault.
Just stacks of hundreds doing nothing.
Right. But capital, in the regulatory sense, is the equity side of the balance sheet.
Yes.
So let's look at it through the lens of a mechanical analogy, because I think this helps. Instead of a concrete foundation, think of bank capital as the crumple zone on a high-performance vehicle.
Okay, I like that.
Right. So the bank's assets, its loans, its mortgage-backed securities, the trading book, that's the kinetic energy of the car moving forward.
Right, generating momentum.
Exactly. And the faster it goes, the more risk it takes on. Now, the capital requirement, that is the engineered crumple zone.
The shock absorber.
Yes. It is the liability buffer, made up of shareholder equity and retained earnings, designed to absorb the destructive kinetic energy of a crash.
Right.
If those assets suddenly go toxic, say commercial real estate loans start defaulting en masse, the crumple zone takes the damage.
Crushing inward so the rest of the car doesn't.
Exactly. It ensures the passenger cabin, which represents the depositors and the broader financial system, remains entirely untouched.
That is a perfect way to look at it. Because the 2023 blueprint we mentioned, it basically looked at the speed of the global financial system and mandated an extraordinarily deep, rigid crumple zone for every major vehicle on the road.
Just incredibly thick armor.
Yes, but the 2026 blueprint we are analyzing today, it argues that engineering was fundamentally flawed.
How so?
It suggests that a slightly thinner, more optimized crumple zone is completely sufficient to absorb those exact same macroeconomic shocks without sacrificing the safety of the depositor.
Okay, so a lighter frame, but still safe.
That's the argument. And to understand the genesis of this whole engineering debate, we really have to look at the Basel III endgame.
Right. The source material heavily references this framework.
Constantly. And the context here requires us to look back at 2008.
The global financial crisis.
Exactly. In the aftermath of that crisis, international regulators convened in Basel, Switzerland.
Right.
And the overarching realization was that banks had been using their own internal, highly optimistic risk models to calculate the size of their crumple zones.
So the banks were grading their own homework.
100%. They modeled toxic subprime collateralized debt obligations as practically risk-free.
Wow.
They held almost zero capital against them. And so when the market turned, there's no crumple zone. The passenger cabin was immediately crushed.
Just devastating the economy.
So Basel III was the international agreement to fix that. It dictated standardized models for how banks must evaluate credit risk, market risk, and operational risk.
And so the endgame portion of that title, that refers to the final implementation of those post-2008 standards here in the U.S.
Right.
And the 2023 version of the endgame was notoriously aggressive.
Extremely.
It essentially sought to strip large banks of their ability to use internal models altogether for certain risk categories.
Right. Moving them to government models.
Forcing them onto standardized, highly conservative government models. But the 2026 version drastically walks that back.
It does.
And the sources note the regulators didn't just tweak the general capital requirements, they specifically targeted something called the GSIB surcharge.
Yes, the GSIB surcharge. This is crucial.
Can you break that down?
Sure. GSIB stands for Globally Systemically Important Banks.
Okay.
This applies to the 8 largest, most highly interconnected banks in the United States.
The real giants.
The titans. And the theory behind the surcharge is pretty straightforward. If a regional bank fails, the FDIC can step in over a weekend, arrange a shotgun marriage with a healthier bank, and the broader economy barely notices.
Right, it's a localized problem.
Exactly. But if a GSIB fails, the interconnected web of derivatives, the clearinghouses, the global dollar funding markets, it all seizes up entirely.
Contagion.
Complete contagion. So, because their failure poses a systemic existential threat, regulators levy an additional capital surcharge on them.
Just a little extra padding.
Yeah, it's an extra layer of equity they must hold simply for the privilege of being massive and interconnected.
Right. Now, the March 2026 documents show the Fed explicitly adjusting this surcharge by altering how they calculate short-term funding risk.
Yes.
And this is a critical mechanical detail because short-term wholesale funding, meaning relying on the repo market or overnight commercial paper to fund long-term illiquid assets.
Which is incredibly dangerous.
Highly dangerous. That was the exact mismatch that destroyed Bear Stearns and Lehman Brothers.
Precisely.
But the regulators have now updated the economic parameters in their models. They looked at the current liquidity coverage ratios of these big banks and determined that the probability of a systemic short-term funding freeze is just significantly lower than previously modeled.
Right. And by recalibrating those specific probability models, the mathematical output naturally dictates a lower required GSIB surcharge.
The math just spits out a lower number.
Exactly. The regulatory argument is that this simplifies the compliance framework, it eliminates redundant buffers, and it maintains a highly resilient banking sector that is capable of intermediating credit for the real economy.
Well, and when you adjust the models to require less equity capital, you immediately alter the incentive structure of the entire banking industry.
Massive shift in incentives.
Because if the government officially declares that your crumple zone can be, say, 4.8% thinner,
That unlocks
billions of dollars,
Yeah.
money that was previously trapped on the balance sheet serving as deadweight loss absorbers.
Right.
And this transition in the math brings us directly to the banking industry's perspective, what the market is characterizing as a massive multi-billion-dollar windfall.
Windfall is the word. The financial press in the source material categorizes this 2026 ruling as a, quote, spectacular victory for the banking sector.
Spectacular, Victor.
And you only really grasp the scale of this victory when you contrast it with the existential threat they perceived in that 2023 draft.
Right, because that earlier proposal, it wasn't just a minor tweak.
No, it proposed double-digit percentage hikes in capital requirements.
Just staggering increases.
For a globally systemically important bank, raising their capital levels by 15 or 20%,
Yeah.
I mean, that would require retaining years of earnings.
Shutting off the dividend taps.
Exactly.
Yeah.
Drastically shrinking their balance sheets by turning away new corporate lending. It was a worst-case scenario for them.
So they fought back.
Aggressively.
The text details this unprecedented, relentless lobbying campaign spearheaded by the major banking trade associations.
It was a full-court press.
It really was. This wasn't standard industry pushback. They mobilized corporate treasurers, small business associations, lawmakers across the political spectrum.
Everyone they could get on the phone.
Yeah, and the core of their argument was that the 2023 rules were fundamentally pro-cyclical and economically destructive. They argued that overcapitalizing the banks acts as a massive tax on credit creation.
And that lobbying effort yielded a very specific, highly quantifiable result. Analysts at Morgan Stanley ran the cross-sectional data on the banking sector following this March 2026 announcement.
Okay, what did they find?
They estimate that the large U.S. banks have been holding roughly $175 billion in excess capital.
175 billion.
Billion, with a B.
That is, wow. That figure is basically the focal point of this entire macroeconomic debate.
It really is the anchor of the whole conversation.
Because the banks have been operating with these massive excess buffers, specifically because of the regulatory paralysis over the last 3 years.
Right, they were essentially frozen.
They couldn't model their future return on equity because they didn't know if the punitive 2023 rules were going to be finalized.
So they hoarded cash.
They were forced to stockpile equity. Now that the 2026 rules have essentially given them the all clear, that 175 billion transitions from a regulatory necessity to pure excess cash flow.
Available for distribution or deployment.
Exactly. And the sources explicitly state this capital can now be allocated toward increased commercial lending, expanded capital markets activity, elevated dividend distributions, and, of course, highly aggressive stock buybacks.
Right. And this is where we encounter two distinct, highly polarized narratives regarding how this capital will actually move through the economy.
The favorable versus the skeptical.
Exactly. The favorable narrative, driven by the banking executives, relies on the concept of the money multiplier.
Okay.
They argue that capital locked in a regulatory buffer is sterile. It produces nothing.
It's just sitting there.
Right. By releasing this $175 billion, banks can lever that equity up. A single dollar of freed-up equity capital can support $10 or more of new commercial lending.
So a massive injection of credit.
That's the theory. They project this will lower borrowing costs for mid-market corporations, increase liquidity in the corporate bond markets, and provide the credit necessary for industrial expansion and job creation.
Okay, I have to jump in here because I find that lending narrative highly optimistic.
You're not alone in that.
Right, especially when you look at the actual mechanical incentives driving bank executives today.
The realities of Wall Street.
Exactly. The macroeconomic environment has to actually demand that credit. If a massive institution suddenly has billions in excess equity legally freed up, there is absolutely no mandate requiring them to originate loans to Main Street businesses.
None at all.
We have to look at the immediate pressure from institutional shareholders. Return on equity, or ROE, is the primary metric by which bank CEOs are judged and compensated.
Right, that's how they get their bonuses.
Yes, and increasing the numerator, so net income through actual lending, that's slow. It's risky. It's highly dependent on the broader economic cycle.
It takes years to see those returns.
But decreasing the equity base through share buybacks, that provides an immediate risk-free boost to ROE and earnings per share.
Right, and that is the exact friction point analysts in the source material highlight. They warn that, quote, some will benefit more than others, meaning the deployment of this windfall will not be uniform. The actual distribution between real economy lending and financial engineering via buybacks,
Right.
it's going to be dictated by the specific business model of the institution.
Give me an example of how that plays out.
Well, think of a regional bank that is heavily focused on commercial and industrial lending.
Okay.
They might use the regulatory relief to expand their loan book, trying to capture market share in a high interest rate environment.
That makes sense for them.
But then look at a universal bank with a massive trading desk and intense pressure from activist investors.
Right.
They are highly incentivized to deploy a massive share repurchase program.
Shrinking the supply of outstanding shares while maintaining the same underlying earning power, which mechanically forces the share price higher. It is a highly efficient mechanism for returning value to institutional investors and pension funds.
It works beautifully for the stock price.
But it completely short-circuits the narrative that lower capital requirements automatically equate to a booming real economy. The capital just stays trapped in the financial markets.
Right. But honestly, the realization of either scenario, whether it's the lending boom or the buyback bonanza, it was entirely dependent on the regulatory architecture shifting in the bank's favor.
They needed this rule change to happen.
They did. And to understand how the banking sector achieved this rollback, we really have to examine the profound internal schism within the Federal Reserve itself.
Yes, the internal battle.
Because the March 2026 announcement did not occur in a vacuum. It was the culmination of a brutal philosophical battle over the very nature of financial risk.
The source material frames this as a clash of regulatory titans, specifically highlighting the deep divide between Michelle Bowman and Michael Barr. And this conflict elevates what is basically dry regulatory policy into a high-stakes ideological war over how to manage a $20 trillion economy.
It is massive.
The text notes that the Basel Endgame project was intentionally dragged out, just mired in endless comment periods and quantitative impact studies.
Just stalling, essentially.
Yeah, stalling until the Trump administration effectively shifted the balance of power, aligning the regulatory apparatus with the banking industry's perspective.
Let's dissect the two architects of these warring philosophies, because it's fascinating.
Let's do it.
The primary architect of the new, relaxed 2026 rules is Fed Vice Chair for Supervision, Michelle Bowman.
Okay.
Her regulatory philosophy, as she outlined during the Fed board meetings, centers on the concept of calibration.
Calibration.
She stated explicitly that these new changes better calibrate the capital requirements to actual risks while maintaining a system that is fundamentally robust.
So her emphasis on actual risk versus hypothetical tail risk, that seems to be the crux of her argument. Bowman's perspective suggests that the post-2008 regulatory environment became highly reactionary.
Overly defensive.
Yeah. She points to the layers of overlapping regulations, the stress capital buffers, the liquidity coverage ratios, the total loss-absorbing capacity requirements.
It's an alphabet soup of rules.
It really is. And her argument is that the 2023 draft, the one authored by Michael Barr, attempted to solve the same risks multiple times.
Double counting the risk.
Right, double counting operational risk and effectively penalizing the banks for a crisis that the current regulatory architecture has already solved.
She views the strict 2023 rules as a parking brake applied to an engine that is already running safely.
That's a great way to put it.
Yeah.
Now, on the opposing side of this philosophical divide is Democrat Fed Governor Michael Barr.
The architect of that strict 2023 blueprint.
Right. And his public opposition to Bowman's 2026 adjustments is unusually fierce for a central banker.
Very pointed language.
He issued a statement calling the rollback unnecessary and reckless.
Reckless is a strong word in central banking.
Very strong. Barr's philosophy is rooted in the inherent unpredictability of financial contagion. From his perspective, the hypothetical tail risk that Bowman views as overly punitive, that is the exact mechanism that causes global depressions.
Right.
Barr believes that when you are dealing with institutions that hold trillions of dollars in assets, attempting to perfectly calibrate capital to a base case economic scenario is an exercise in hubris.
You can't predict the future.
You just can't. He argues that systemic shocks, whether from a global pandemic, a sudden sovereign debt crisis, an unforeseen derivative implosion, they do not respect historical probability models.
They really don't. And this ideological divide, it isn't just rhetoric. It actually manifests in a staggering mathematical discrepancy in the source material.
The math war.
Yes. We have a full-blown math war occurring at the highest levels of financial oversight.
So break down the numbers on this.
Okay, so the 8 globally systemically important U.S. banks hold approximately $1 trillion in combined capital.
$1 trillion.
The Federal Reserve, operating under Bowman's new framework, officially estimates that the 2026 rule reduces required capital by about $20 billion.
$20 billion, okay.
But Michael Barr looks at the exact same regulatory text. He applies his own analysis and argues that when you factor in the interaction with other policy tweaks, the real reduction is closer to $60 billion.
A $40 billion delta.
Right, between the vice chair for supervision and the former architect of the rules.
How is that possible? To understand how two top-tier financial regulators who are backed by the most sophisticated quantitative analysts on Earth.
The smartest quants in the room.
How can they arrive at a $40 billion discrepancy looking at the exact same balance sheets?
Well, you have to look at the mechanics of stress testing. Capital requirements are not calculated based on a static snapshot of a bank's current health.
It's not just looking at a checking account balance.
No, not at all. They are derived from dynamic models that simulate future macroeconomic devastation.
Okay, right. The Federal Reserve runs the Comprehensive Capital Analysis and Review.
CCR.
CCR, yeah. They take the bank's entire portfolio and mathematically subject it to a severe global recession.
A doomsday scenario.
Right. They model out a massive spike in unemployment, a catastrophic drop in commercial real estate prices, extreme widening of corporate bond spreads.
And the discrepancy between Bowman and Barr emerges because they are fundamentally weighting the variables in these simulations differently.
The modeling assumptions drive the output.
Precisely. Bowman's $20 billion estimate likely assumes a degree of dynamic hedging.
What does that mean in practice?
Her models might assume that as the macroeconomic environment deteriorates, bank management will actively de-risk. They'll sell off toxic assets. They'll raise capital organically well before the system actually breaks.
So assuming the banks act rationally to save themselves.
Right. But Barr's $60 billion estimate likely looks at a cascading failure scenario.
A panic.
Exactly. He is likely factoring in the interaction between the relaxed Basel rules and secondary policy tweaks, assuming that in a true panic, liquidity just vanishes.
Hedging strategies fail.
Exactly. And the banks are forced to eat the entirety of the losses on their balance sheets. The math changes drastically based on whether you believe the financial system is inherently self-correcting or inherently fragile.
Which means the structural integrity of the U.S. banking system currently rests on which hypothetical future the sitting regulators believe is most statistically probable.
That's exactly what it comes down to.
The fact that the models can be tweaked to produce a $40 billion variance, just depending on the political composition of the Federal Reserve, that is deeply unsettling.
It doesn't inspire a ton of confidence.
No. And Michael Barr's warning about the fragility of these models brings us directly into the wider anxieties echoing through the market.
The critics.
Right. Because while the banking sector celebrates a historic victory, a vast coalition of financial critics and sovereign risk analysts are currently sounding the alarm.
Very loudly. The critics view this 2026 rollback not as a calibration, but as a dangerous erosion of the post-2008 consensus.
Tearing down the firewalls.
Exactly. Their central argument is that the banking lobby has successfully utilized a period of relative calm to dismantle the exact firewalls that produced that calm.
Wow.
They point to the inherent pro-cyclicality of bank behavior. When times are good, loan losses are near zero, and capital feels like a burden.
Why do we have all this money locked up?
Right. But the critics note that the timing of this specific capital reduction is highly problematic given the current macroeconomic landscape.
Extremely problematic. The source material explicitly cites sharply rising geopolitical risks as a primary concern.
Yeah, the world is not exactly stable right now.
No, we are looking at a world of fragmenting supply chains, persistent inflation volatility, unpredictable trade conflicts.
Right.
Shrinking the crumple zone of the financial system right as macroeconomic volatility is spiking is objectively risky.
To say the least.
But the critics are pointing to something far more systemic than just geopolitical tension. They are highly focused on the massive, opaque risks tied to the explosion of private credit.
Yes. Private credit is the crucial variable that the standard regulatory models struggle to quantify.
It's the Wild West.
It really is.
Mm.
Over the last decade, as traditional banks faced the stricter post-2008 capital requirements, a massive shadow banking sector emerged to fill the void.
Right, because the demand for loans didn't go away.
Exactly. Private equity firms, hedge funds, business development companies, they bypassed the banks and began lending directly to highly leveraged corporations.
Direct lending.
And this private credit market is now a multi-trillion-dollar ecosystem operating largely outside the purview of the Federal Reserve's direct oversight.
Which is terrifying. But the banking lobby frequently uses private credit as a defense, right?
Oh, all the time.
They argue that if regulators force traditional banks to hold too much capital, they can't compete. And the lending activity just migrates into the opaque shadow banking sector where it is even riskier.
Out of sight, out of mind.
Right. They argue that lowering capital requirements allows the regulated banks to reclaim that market share, increasing overall systemic visibility.
But the critics counter that the risk never truly left the traditional banks. It merely mutated.
Mutated how?
Well, the globally systemically important banks are deeply interconnected with the shadow banking sector.
Right.
Who provides the massive subscription line facilities to the private equity funds.
The big banks.
Exactly.
Yeah.
Who provides the leverage to the private credit vehicles, the traditional banks.
So they're still on the hook.
They're completely on the hook. If a severe recession triggers a wave of defaults in the highly leveraged private credit market, those shadow lenders will face margin calls and liquidity crunches.
And the contagion flows upstream.
Immediately. Back onto the balance sheets of the GSIBs.
And the sources note we are already seeing early indicators of liquidity stress. Major U.S. banks are currently tightening their own lending standards,
Going back.
preparing for an economic slowdown. And several large investment funds have recently limited client withdrawals.
Which is huge. Freezing redemptions is the ultimate red flag in finance.
It means the money isn't there.
It means the underlying assets are illiquid and the fund cannot meet its cash obligations.
Right. The critics are looking at a system where non-bank lenders are freezing withdrawals, traditional banks are tightening credit, geopolitical shocks are multiplying, and the regulators have just decided to significantly reduce the mandatory safety buffers.
To borrow your earlier analogy, the critics argue that the banking sector successfully lobbied to remove their seatbelts right as the vehicle hit a massive patch of black ice.
Yeah, that's exactly what it feels like.
And this assessment isn't isolated to academic critics or disgruntled former regulators.
The rating agencies are stepping in.
Yes. The independent arbiters of sovereign and corporate risk have officially weighed in. Moody's, one of the premier credit rating agencies globally, issued a stark, highly formal verdict immediately following the March 2026 announcement.
What did they say?
They declared the Federal Reserve's capital reduction to be broadly credit negative for U.S. lenders.
Credit negative. Now, a credit negative designation from Moody's is not just rhetorical pushback.
No, it has real teeth.
It has immediate mechanical implications for a bank's cost of capital. A credit rating agency's sole purpose is to assess the probability of default.
Right.
By issuing a credit negative outlook, Moody's is signaling to the global bond markets that the structural safety of U.S. financial institutions has degraded.
They're less safe than they were yesterday.
Exactly. And even if the probability of failure only increased by a fraction of a percent, that increased risk must be priced into the market.
Right. When a bank's credit profile degrades, The institutional investors who buy bank debt, pension funds, insurance companies, sovereign wealth funds, they demand a higher yield to compensate for the newly introduced risk.
They want to be paid for taking on more danger.
Exactly. If a bank has to pay higher interest rates to fund its own operations, its net interest margin compresses. This introduces a fascinating macroeconomic friction. The regulators lowered capital requirements to boost bank profitability and ROE, but the resulting credit negative assessment from Moody's might simultaneously increase their cost of debt capital.
Potentially neutralizing a portion of the windfall.
Precisely. The market corrects itself.
But Moody's warning went far beyond the immediate cost of debt. Their analysis highlighted the danger of systemic unpredictability.
Unpredictability is the enemy of markets.
Right. Under a highly capitalized system, you don't necessarily have to worry about the specific idiosyncratic risks of a single bank, because you know the massive equity buffer can absorb almost any localized shock.
The crumple zone is big enough for everyone.
Right. But as the regulators shave off those buffers, the system loses its margin of error. Because bank business models vary so wildly, the impact of thinner capital cushions will be dangerously unpredictable in a true stress scenario.
Moody's is pointing out that a one-size-fits-all reduction in capital masks the underlying structural weaknesses of specific institutions.
So it hides the rot.
Yeah. A 4.8% reduction might be perfectly safe for a universally diversified bank with a massive, sticky retail deposit base.
A really stable giant.
Right. But that same reduction applied to an institution heavily concentrated in, say, commercial real estate lending,
Which is hurting right now.
or heavily reliant on flighty, uninsured wholesale funding.
Silicon Valley Bank style.
Exactly. For them, that reduction could be the difference between survival and insolvency. If a sudden macroeconomic shock hits, thinner overall capital means the market won't know which specific institution is actually insolvent until the contagion has already spread.
Because everyone looks fine until they don't.
Right. It reintroduces counterparty paranoia into the interbank lending market, which is exactly what froze the global system in 2008.
Nobody trusts anyone. We are looking at a deeply fractured landscape here. Wall Street is modeling the deployment of a multi-billion-dollar windfall. Top-tier regulators are engaged in a vicious public dispute over $40 billion modeling discrepancies. And the premier credit rating agencies are explicitly warning the bond markets that U.S. financial institutions are now objectively riskier.
It's a powder keg.
It brings us to the immediate reality of where the system stands today. The March 2026 announcement was the starting gun, but the implementation is where the actual financial engineering occurs.
Yes. The regulatory timeline now enters a highly critical 90-day window.
90 days.
The broad architecture of the rules has been unveiled, but the banking industry now has 90 days to review thousands of pages of highly technical, deeply complex regulatory text.
So this is the period of quantitative impact studies.
Right. Every major bank currently has armies of quantitative analysts, risk managers, and regulatory attorneys locked in secure rooms,
Just crunching the numbers.
running these new proposals against their specific proprietary portfolios.
They are essentially running thousands of Monte Carlo simulations, attempting to figure out the exact down-to-the-penny impact on their risk-weighted assets.
Right.
They have to map these new Basel parameters against their existing operational risk models, figure out how the revised GSIB surcharge interacts with their current funding structure,
It's incredibly complex.
and ultimately model out exactly how much excess capital they can legally extract for distribution.
And, while the broader banking trade associations immediately praised the ruling as a macroeconomic victory,
They took the PR win.
they did. But the executives running the actual institutions are being highly tactical. Scott O'Malley, the CEO of the International Swaps and Derivatives Association, ISDA,
Okay.
he provided a very telling perspective. Now, ISDA represents the massive trillion-dollar derivatives market,
A huge player.
and they fiercely lobbied against Barr's original 2023 draft, arguing it would destroy liquidity in the hedging markets.
Right.
O'Malley admitted that upon initial review, the 2026 rule represents a, quote, significant improvement. But he immediately caveated that assessment, stating that, quote, the devil is in the details.
The devil is always in the details, especially in derivative markets. That's where the true complexity of capital regulation lives.
Oh, absolutely.
A single obscure tweak to how the Federal Reserve models the netting of derivative exposures, or how they calculate the credit valuation adjustment that can shift capital requirements by hundreds of millions of dollars.
Just massive swings based on a tiny formula change.
This is exactly why individual bank spokespeople and CFOs have remained aggressively silent. They're declining immediate comment to the financial press while they digest the fine print.
They're reading the text carefully.
They know that a perceived victory at the macro level can easily contain highly punitive micro-level traps for specific trading desks.
Right. And this exhaustive 90-day review period is the final crucible. The banks will use this time to identify every remaining inefficiency, optimize their balance sheets to exploit the newly relaxed parameters.
Find every loophole.
Every single one. And prepare their capital distribution plans for shareholder approval. The decisions made in these quantitative modeling rooms over the next 3 months, they will dictate the structural foundation of the U.S. economy for the next decade.
Which makes it crucial to connect this deeply technical mathematical battle directly back to the broader reality of the market.
Why the listener should care.
Exactly. It is incredibly easy to view a debate over risk-weighted assets, G-SIB surcharges, CCR modeling as esoteric Wall Street trivia.
It sounds so dry.
It sounds completely dry. But this regulatory mathematics is the hidden infrastructure that dictates the flow of trillions of dollars in the real economy.
Right.
The outcome of this $40 billion discrepancy dictates the availability and the cost of credit if, say, a mid-sized logistics company wants to expand its fleet.
Can they get the loan? At what rate?
Exactly. It impacts the fundamental stability of the macroeconomic cycle that determines corporate hiring and consumer demand. It actively dictates the velocity of the stock market.
Through the buybacks.
Right. As billions of dollars of newly freed capital are suddenly funneled into share repurchase programs, directly altering the valuations within every major index fund and retirement account, the engineering of the crumple zone matters to everyone on the road.
It really does. And understanding the mechanics behind this shift, understanding why $175 billion was hoarded, and how a change in a short-term funding probability model suddenly unlocked it, that provides a massive analytical advantage.
Absolutely.
Regardless of whether you align with Michelle Bowman's focus on capital velocity or Michael Barr's focus on systemic tail risk, recognizing that the incentive structure of the global financial system just shifted radically, that is essential for navigating the coming economic cycle.
And that leaves us with a critical, lingering question to consider as the market digests this historic shift.
Right.
We know the banking industry just spent years and unimaginable amounts of capital successfully lobbying to dismantle the strict structural pillars of the 2023 regulatory draft.
We know they won.
We know they view this new, relaxed framework as a spectacular victory. So what exactly are those armies of quantitative analysts and regulatory attorneys going to be executing during this 90-day implementation window?
Working around the clock.
As they pore over thousands of pages of deeply complex regulatory code, optimizing their models, isolating every newly created loophole to maximize their return on equity, one has to wonder. When the macroeconomic cycle finally turns, when the private credit markets experience the first true liquidity crisis, and the next profound financial storm breaks, will we look back at March 2026 as the exact moment we perfectly calibrated our economic engine for maximum growth? Or will we look back at it as the moment we willingly dismantled our own structural defenses, unlocked the vault, and chose to forget every single hard-learned lesson of 2008?
The models can only predict so much. The reality of that decision will only be revealed when the system experiences its next true unmodeled shock.
Thank you for joining us for this deep dive. Keep examining the assumptions behind the math.